You're a teller at a bank branch in Mexico. It's 2008. It's a Tuesday, and there's a queue. A box comes through the window, not a bag, a box. And it fits. Not roughly, exactly, like the window was measured for it. Behind it, another one. Same box, same fit. Hundreds of thousands of dollars a day. Through a teller window. That's not a figure of speech. It's paragraph 50 of the Statement of Facts HSBC, signed in federal court. Somebody measured that window. Somebody had the boxes made. The document never says how big. It doesn't have to. Over 4 years, at least $881 million of drug money went through this bank and came out clean. HSBC admitted that. You think money laundering is criminals beating the bank. At industrial scale, the bank is the machine. Start where the money starts. Not a number in an account, paper, bricks of 20s by the ton. And cash is the most useless asset on earth. You can't wire it, can't buy a building with it, can't explain it. Put more than $10,000 in cash into a U.S. bank, and the bank files a report. Break it up to stay under that line, and that's its own federal felony. 5 years. Even if the cash was clean, so it gets washed. 3 moves. Placement. Get it into a bank. Layering. Move it until nobody can see where it started. Integration. Bring it back as something boring. Each of those moves needs a bank to say yes. This is about one that said yes for years. The boxes are placement. That's all they are. The problem was volume. Hundreds of thousands of dollars a day into a branch built for ordinary customers. Between July 2006 and July 2009, HSBC's U.S. arm bought over $9.4 billion in physical American banknotes from its Mexican affiliate. Not wires, notes. Paper on planes. More cash than banks bigger than it were shipping. A red flag you could see from orbit. And they knew. An internal HSBC email, September 2008, in the Senate's exhibit record. But cash in a Mexican bank is still cash in a Mexican bank. To be worth anything, it has to become dollars in New York. A Mexican bank can't hold an account at the Federal Reserve, so it opens one at an American bank instead, a correspondent account. And through that one account, every customer it has reaches the dollar. And the dollar clears in New York. Around 95% of cross-border dollar payments pass through a single New York system. So a box through a window in Mexico becomes a wire out of New York. One hop. HSBC's U.S. arm rated Mexico standard risk. It failed to adequately monitor $670 billion in wires from its own Mexican affiliate, part of over $200 trillion it wasn't screening. HSBC admitted that. In 2010, HSBC's own North American compliance lawyer asked why nobody had told her. The answer from the group's head of compliance? The money's inside. It still looks exactly like what it is. Layering. And the version that did most of the work here never moves a dollar across a border. It's called the black market peso exchange, and it's elegant, which is the irritating part. The cartel has dollars in the United States, A broker buys them at a discount and pays the cartel in pesos at home. No cash crosses a border, no report fires. Then the broker sells those dollars to importers who need to pay American exporters. Real goods, real invoices, real shipping. The drug money leaves as a payment for washing machines. That's where the $881 million went. Sinaloa and Norte del Valle combined, largely through trade. The other half of layering is companies that aren't companies. Delaware has over 2.1 million registered business entities against under 1 million residents. More companies than people. By now, the money has no past, which raises the only question left. Was anybody watching? Integration. The money comes home wearing a suit, a property, a business, a loan that repays itself. It isn't disguised anymore. It's legally somebody's asset. Those 3 stages are a teaching model, not a timetable. Real schemes blend them, skip them, run them backwards. How much runs through the whole cycle? Nobody actually knows. The UN's estimate, from 2011 off 2009 data, and still the figure they quote, is 2 to 5% of world GDP, $800 billion to $2 trillion, which would be a bleak enough story if nobody had noticed. They noticed, in writing, for years. This is the part that's supposed to be the safety catch. A bank that thinks a transaction is wrong files a suspicious activity report, a SAR, to the U.S. Treasury. The whole thing in one line from the FinCEN files. The alarm is a form. It is not a break. A bank can call a payment suspicious, write that down, send it in, and release it the same day. No rule requires it to close the account. Not after one report, not after 50. About 4.5 million are filed every year. As of November 2025, FinCEN had 244 staff, down from 275. That comparison is our arithmetic on 2 published figures, not an official statistic. Nobody publishes how many get read. Not sure that helps. HSBC, internally, November 2008. Their spelling. In 2020, journalists got hold of a pile of these reports, under 0.02% of everything filed. In that sample alone, banks moved more than $2 trillion they had flagged themselves. The alarms rang, in writing, for years. So what happened when the biggest bank on earth got caught? September 2012. The Justice Department's own money laundering section recommends prosecuting HSBC. Senior leadership overrules them. That month, Britain's Chancellor writes to the chairman of the U.S. Federal Reserve. A prosecution could have very serious implications for financial and economic stability, particularly in Europe and Asia. A foreign finance minister arguing down an American prosecution. It worked. December 11, 2012. A deferred prosecution agreement. The charges are filed, then held, not dropped, not tried. $1.921 billion. Not a fine. Forfeiture is giving it back. HSBC's pre-tax profit that year was $20.6 billion. $396 million a week. The largest penalty of its kind ever imposed on a bank cost HSBC under 5 weeks of profit. No HSBC executive director or compliance officer was criminally charged. Cartel side launderers were arrested, extradited, convicted, and the Statement of Facts says so. 6 weeks later, the prosecutor who announced the deal sat down with PBS Frontline. And then the interviewer asked him the only question that matters. None of this was improvised. There was a document, and the Attorney General in 2012 wrote it himself, 13 years earlier. 16th of June, 1999. A memo goes to every U.S. attorney in the country, bringing criminal charges against corporations. It lists what prosecutors should weigh before charging a company. One factor is collateral consequences, harm to employees, shareholders, people who did nothing. That's the doctrine HSBC walked out on. Here is the next thing the same memo says. The memo's own safeguard. Same document, same author. The factor got quoted for 13 years. The sentence limiting it didn't. And the deal itself? 7 months into probation, HSBC's Hong Kong arm opened an account for a 100% in 100 days scheme. More than $30 million moved through it. Regulators froze the scheme's assets. The account stayed open, and another $7 million left inside a week. The people it took from were mostly immigrant families. In 2017, the agreement expired, and the charges were dismissed. HSBC was never convicted of anything. In 2021, Britain's regulator fined it £64 million for monitoring failures running from 2010 to 2018, through the entire probation and beyond. That's the machine. A mouth, a pipe, a spin cycle, and a safety catch that was never a brake. Only a form. 10th of October 2024, TD Bank pleaded guilty. The first U.S. bank in history to plead guilty to conspiring to launder money. Over $3 billion and a 4-year monitor, 12 years after HSBC. The boxes were built to fit. The alarms rang for years, in writing. The biggest penalty of its kind ever imposed on a bank cost it under 5 weeks of profit, and no banker was charged. The machine still runs. Once, 12 years late, the law finally used its own words.